Everyone, welcome to Finance Fridays. This is a GSP series on real estate finance. Specifically today, we're doing a market update by sector, covering retail, office, multifamily, and industrial, and the impacts of COVID on tenancy, rents, the bottom line, and the importance of managing relationships and expectations during this difficult time. My name's Alina Mardesich. I'm one of the real estate advisors here at George Smith Partners. I'm here co-moderating the panel with GSP principal and co-founder Gary Mozer. I have a shortage of webinars going on daily at the moment, so I want to thank everyone who's taken the time to join and participate. For future reference, this webinar is being recorded and will be available to watch on the GSP YouTube channel that you can also subscribe to. You can also find a link to this webinar series on the George Smith Partners website. Gary, I will turn it over to you and let you set the stage.
Hi, this is Gary Mozer. Thank you very much for joining us. We have a very distinguished panel today. We're going to let them introduce themselves. I think that the most important thing that we can talk about is that things are not homogeneous. You know, if we talk about retail, there's malls and there's strip centers. There's stuff that's happening in the grocery anchored shopping center in Main and Main. There's stuff that's, you know, unanchored in the tertiary market. Same thing with industrial. You have, you know, big box distribution for Amazon. You have multi-tenant industrial. So we're not trying to paint everything with one brush, but we have experts in each of these areas that are going to share with us what they're seeing, what they're doing differently, and some insights that might help you in your endeavors. So I'm going to go around and I'm going to have people introduce themselves and give us a few minutes about their companies and a little bit about you know, what's really happening. I'm going to start with Stephen Usdan. He's with CCA and Cornwasser, and he's in the shopping center business. Stephen.
Thanks, Gary. Good morning, everybody. My name is Stephen Usdan, and I've been asked to give the retail update. Since 1998, I've run a family office boutique real estate investment firm that invests primarily in value add retail with current cash flow, where we can substantially grow net operating income for our investors. We currently have about 5 million square feet. Our properties are located in Utah, Idaho, Montana, California, Oregon, Arizona, New Mexico. You know, I'm very, very proud that the investors who started investing with us in 1998 still invest with us. And we have a wonderful small group of publicly held institutions, family offices, and high net worth individuals that are partners. We have grocery tenants like Kroger, Smith's, Sprouts. We have Target as a tenant. We have Walmart as a tenant. We have TJ Maxx as a tenant. The other soft goods tenants, Nordstrom's Rack and In-N-Out Burger and Chick-fil-A and other national, regional, and local mom and pop retailers. This is a challenging time, but as Gary pointed out, that this is a time where not every property is the same, not every tenant is the same, and it's also a time that we found that by applying creative solutions, we've been able to maximize value for our partners.
Thank you, Stephen. Can I just interject? If you are comfortable muting when you're not speaking, that might lessen some of the feedback that we're getting.
Stephen, can you share with us a little bit about rent collections? You know, we're hearing that the essential businesses are paying their rent. Some of the credit tenants are asking for some deferrals or stuff, and then the mom and pops, how are you keeping them alive? What's happening with restaurants, with gyms, with theaters, and some of the things that are going to be really impacted by COVID?
So I would start by saying that overall in our portfolio, we have collections of approximately 70% of April rent so far. And our portfolio, you know, groceries are a percentage of the portfolio, but we have other major retailers as well. I think that it's incorrect, or I think that there's a false belief that many tenants are not paying rent. I think that I think that, tenants are obligated to pay rent, notwithstanding their initial reaction to COVID and that this is an opportunity not to pay rent. Force majeure in leases expressly excludes the inability to pay rent. And in the discussions with tenants, we also understand that tenants, are not able to operate, have furloughed employees, have closed locations. So we've had a give and take with the major tenants over the past 3 weeks. And what we found is that in many cases, restaurants, even without drive-throughs, have stepped up their operations and are doing a much bigger takeout and delivery business than they ever thought they could do before. There were restaurants asking to go on percentage rent that withdrew that offer because they were doing so well. And then there are other restaurants who are crying the blues. And so I do think that we're seeing the stronger operators outperforming the weaker operators. Yeah, I think that what we're seeing too is credit tenants who, are looking for help because they are losing sales and they are dealing with inventory issues and they are dealing with furloughed employees and reducing expenses. So it's legitimate for them to ask for help, but at the same time, their leases don't give them permission not to pay rent. So there's a negotiation, and it's an important negotiation. But overall, what we found is that when the time is spent with the tenants and listening to the tenants and thinking about what they need, and then thinking about what we as landlords need, what consents we need, whether we want to create a pad, whether there is something else that the tenant would not otherwise have paid attention to, we now have their full undivided attention to have engaging discussions to create value.
Great, thank you very much, Stephen. Eric, I know that you're going to get a lot of your tenants' attention. You're in the office space. Talk a little bit about Regent Properties, and then share with us, how you're getting your tenants' attention and what you think, you can get, how you can help them, how they can help you. You're on mute, Eric.
I was so diligent in putting myself on mute, I forgot. I don't think we need to get our tenants' attention. I think they're getting ours. But we were founded 30 years ago, kind of like Steve's company, as a family office. We've grown over time. We're almost 5 million square feet across a number of markets. We do office, residential, and retail, but primarily office. The vast majority of our portfolio is office. So we have offices on the ground in Dallas, Houston, Denver, Phoenix, San Diego, and LA. Similar to Steve, we have a great group of investors, endowments, pensions, financial institutions, a bunch of ultra high net worth families. So we have a lot of capital that's been committed to us for a while. We typically raise our money in discretionary funds, so we don't have either pressure to do things from a distress point of view, and we much more so have capital to go take advantage of opportunistic transactions that may come our way. So we're mildly excited about what's going to go on over the next year or two. We think there's going to be some
and Eric, you have what? Eric, how much office do you have?
We have almost 5 million square feet of office space. And that's, our office is primarily Dallas, Houston, Phoenix, and San Diego, and Denver. And so, our perspective is, there are a couple things going on. I think, like Stephen was saying, it's really hitting every tenant differently. I mean, there is a lot of opportunism. I don't think you can discount that. I think our number was almost 25% of our portfolio come to ask us for some type of assistance in March. So we were playing a lot of defense. Our simple reaction was, listen, before we talk about letting you out of your rent obligations, or show us your financials. Show us what February, March looks like. Show us what the first quarter looks like. Show us what your application for business interruption insurance looks like, whether or not you're going to get it. Show us that you applied for it. Show us that you applied for a PPP loan. Show us all this information. By rough estimates, 95% of the tenant requests disappeared when we asked for that information, right? The number of tenants we had who told us that we were partners in this It was astounding to me, given that we're not partners because we don't get any of the upside. So I think that really put a lot of the tenant requests to bed. What we have seen that's been fascinating is a huge difference because of regulatory environments. So our collections for April ended up almost 100% in Houston, which is probably the worst hit market right now in the US in terms of coronavirus and oil. Almost 100% in every other market we're in, except for California, where we were 78%. And I chalk that up entirely to, you know, the governor's executive order telling tenants they don't have to pay rent, right? And specifically, I think what's really interesting there is that you would think in the office business, most of the stress would be in the small tenant side. We actually have some good credit small tenant occupancy, right? So we have some big companies that have sales offices, right? So that's not a small law firm. But it was the bigger companies who've been the issues, right? The bigger companies, particularly who have name brands that you'd recognize, who you'd think were in a good credit position and really still are, but are owned by private equity firms who told every company in their portfolio not to pay, right? So I think the best story that we have is a tenant who, well, actually there are two great anecdotes I'll tell. One was a tenant who owned by a private equity firm, big brand name you'd know, not only hasn't paid rent, not only hasn't responded to our request to pay rent, and not only is in a jurisdiction where I'm not even allowed to threaten eviction. I can't even use that word until June 1st because the city passed a more restrictive law than the state. They then called us to ask what we were doing to maintain the building environment in a safe and clean fashion, and was the air conditioning on and all this. It was just unbelievable. Another tenant was in free rent. We just did a brand new lease for them and they asked us for free rent. I mean, so there's definitely a lot of opportunism out there. I think we'll see what May looks like. May is going to be a very different story, for good or for bad. But that's a lot of what we're seeing right now.
Yeah, I'd like to come back to that topic on when we talk about creating value and how you can, you know, how these relationships with tenants are pivoting and changing. But let's come back to that. Bob, you want to introduce yourself?
Thank you, Alina. This is Bob Hart. Hi. I'm the founder and CEO of a company called TruAmerica Multifamily. We concentrate on value-add Class B housing. We're about 95% Class B and about 5% Class A. We're in about 16 major metro MSAs around the country with a 75% concentration on the West Coast and all major metros west of Denver, and about 25% of our apartments are on the East Coast, from kind of the Washington, D.C. area to the south of bottom of Florida. We have about 43,000 units, of which about 60% are investor-owned and about 40% we asset manage. So we have a pretty good footprint. We're the 37th largest operator in the nation. You know, I began the process of, you know, going on defense here, starting at the end of March, beginning of April, with more pessimism, and I've ended the month with more optimism. However, we're definitely have our headgear on here, waiting for May. As Eric was saying, in the states where politicians have been more forceful about eviction moratoriums and not taking removal action on the West Coast, we're less than 90% collected, which surprised me because in some markets we're 97% collected. In Utah and Oregon and parts of Arizona and state of Washington, we have very high collections, which was a very pleasant surprise. But in Southern California, Sacramento, and parts of the Santa Cruz and San Fernando Valley were 90% or even lower. So this is a real test of everybody's ability at the site level and the asset management level to communicate. The whole key is being able to demonstrate to your resident that they still have an obligation to pay rent. However, we can be empathetic and work with them and develop payment plans. About 50% of the folks that haven't paid rent owe the 6%. So 3% are on some kind of payment plan, and the other 3% we're still trying to figure out. So in this environment, we've had to rely heavily on the internet, heavily on virtual tours to keep leasing going, to get money in through, you know, credit card payments and so forth. So it's forced everyone to work a little bit harder, to communicate more, and to be very empathetic with resident issues. And as we enter into May, we'll see what happens, and hopefully the effects of the government's unemployment and other incentives will help folks pay. But let's face it, in April, people were paying with March money. So I think everybody's going to go into the next month with a fair amount of caution.
Thank you very much, Bob. Timur, I'm going to have you take off your mute. You're the darling of real estate being an industrial. I think different from the other three, you're also a developer. So I'd like you to not only touch on what's happening in the industrial market, but also what's happening in the development. Are you able, how are your construction jobs still going, et cetera?
Sure. Can you guys hear me okay?
Yes, we can.
Okay, terrific. Yeah, hi, Timur Tecimer. Our company is Overton More Properties. I'm the CEO and owner of OMP. We're a developer and investor in Southern California and Northern California, primarily of industrial real estate, but also we've been developing and acquiring some self-storage. So along the lines with Steve and Bob and the other panelists, first 2 weeks of March through first 2 weeks of April, definitely playing defense, talking to tenants, partners, lenders, brokers, spending a lot of time with tenants. We collected about 85% of our rents, and clearly a fine distinction between, of that, the 15% that didn't pay, I would say 80 to 90% of those tenants were smaller than 100,000 feet. So the smaller tenants who have really been running on fumes or thin margins over the last couple of years, they have had a difficult time paying. And frankly, I just don't know if they're going to be around between now and the end of the year. We, as Gary mentioned, we have right now about 3.5 million feet under construction of industrial and one self-storage project in both Southern California and Northern California. In Southern California, we have a project right adjacent to the Burbank Airport, a 60-acre site, and we're in full construction. We have very specific site safety protocols, taking people's temperatures, social distancing, folks wearing masks. So we've taken it very seriously, along with all of our competitors who are doing this. Conversely, you look at Northern California, Alameda County, we are completely shut down right now. We have 3 projects that we haven't done anything out there since March 6th. So it's obviously a displeasure to see 2 different counties that have 2 different ways of operating, but it's the cards that we deal with. So we're, personally spending a lot of time, calling assemblymen, calling supervisors, really trying to, modify the shelter in place to include commercial construction, excuse me. We've been creative with the tenants that we have been working with. We look at their leases, we evaluate if there's anything else that we would like to change in that lease, whether it's a termination right, extending the lease with some of the retailers on exclusives. So, to really try to have a better lease at the end of the day. So that's a brief overview.
Thank you very much, Timur. Let's quickly talk about some of our other stakeholders. We have the tenant, which we've talked a little bit about it, but we have our lenders and our investors and our employees. Would anybody like to jump in and talk about how we're doing this differently now that the market's changed because of COVID? Bob, how about you? You're actively operating. People are spending more time in your at their apartments. How are the different stakeholders dealing with it? How are you dealing with your employees? How are you doing anything different for your tenants? You're closing your common areas, and then if they're not paying, what are you talking to with your lenders and investors?
Okay. Well, fortunately, we haven't been in a position, other than in one instance where we have a debt fund loan, to have to deal with our lenders just yet. We're well past break-even points and we're cash flowing, but we've certainly put all our plans in motion to do that and have all the information needed to do that, but we haven't had to do that. But the key is being ready, is knowing who to contact and making sure you have everything in place. With regard to employees, I mean, we're all dependent on making sure that our employees are well equipped with the tools they need. We've set up all our employees at home with printers, computers, Zoom accounts, and everything they need to communicate. And it's actually worked out quite well. It almost seems like people are rallying together in a way that they haven't before and are really, really going above and beyond the call of duty to communicate. The tenants are a little different. A lot of tenants who are avoiding confrontation obviously are not communicating, and you know, there has to be a lot of extra effort applied there to get people to the table, and that has required all sorts of creative efforts at the property level, from welfare check type door knocks and things of that nature, but stopping just short of posting notices or doing anything that could trigger punitive action. We've seen that happen now in the state of Washington, the state of California, to one particular owner. We certainly don't want to set any precedent for that because that'll hurt the whole industry. And so we're, you know, using a light touch to approach this, and one of sensitivity and empathy in dealing with residents, and certainly being highly supportive of employee stress due to this situation and how hard people are working.
Eric, as Bob's saying, there are a lot of people are working at home. We're changing our working patterns. How do you see that impacting office? I know anybody with small kids wants to get the hell out of home and getting back into the office, but how do you see the ramifications from the short-term effects, you know, changing the way we work and the way you design your office, and like new leases you're doing, you know, are the cubes further apart? You know, what are you seeing as the actionable items, you know, this quickly into the crisis?
Yeah, a little bit of what Bob was saying. You know, we, as I mentioned before, we are seeing a lot of tenant opportunism, right? But we are seeing tenants who have issues, right? So we've had a number of tenants who are very concerned about what we're doing in the buildings, while also they're not in the buildings, right? So it's been a kind of a weird situation there. You know, so from a short-term point of view, they're arguing that they do or don't have possession of space that the city has or has not told them they're allowed to be in. We definitely have tenants we're dealing with from a true sympathy point of view. And we have a corporate headquarters of a big restaurant company, right? They may file bankruptcy in the next couple of months, right? Sooner than later. We are working with them as best we can, right? But there are definitely a lot of groups who are trying to take advantage of the situation. So the reason I started that way, to answer your question, is that we've seen a set of varied reactions to space demands going forward, right? And I like to tell a joke, you know, about a week into this, I had an investor call me and said, oh my God, our office portfolio is going to zero. No one's ever going to rent office space again. You know, this is terrible. Everyone's working from home. And I said, listen, maybe. I don't think so. I mean, to me, this is just something else we have to deal with, like telecommuting or hoteling. And these are trends that we've made a lot of money on in the past. We'll figure it out. I certainly don't have an answer right now. He called back 10 days later and said, oh my God, we're going to make so much money on our office portfolio because my wife and I hate each other. I want to beat my kids. I can't wait to get to the office. And when I do get back to the office, I want to shut my door. All my staff is going to want to have more space. They're going to want to be 6 feet away. They're not going to bench anymore. They're going to want to make sure the cube is further apart. And look, there's been a lot of talk in the press. Is everybody going to be working at home, or they're not going to? From our point of view, what we've consistently seen, and you can even go back to Yahoo several years ago, pulling telecommuting and forcing everyone back to the office, is that there's a benefit for people to be in the office, right? There's a benefit to see someone in person and have a discussion. This whole discussion would be better in person, right? And so the idea that people will want less office space, maybe, I don't think so. I'm not just talking in my book saying that, right? The only data that we have is actually the opposite. So Texas, which is the only market where we're seeing vibrant leasing activity right now, it's really frozen everywhere else, and probably stretching even to use the word vibrant for Texas. We have a very big tenant, an almost 100,000 foot tenant we're negotiating with, who said we're putting our deal on hold, one of our development projects. And we said, oh no, is this the economy? What's wrong? They said, no. We're going back to space plan because we want to give all of our employees more space. We're trying to figure out what our guidelines are going to be, but we're probably going to come back to you with a demand for 15 to 20% more space. So that's the only data I have, right, which is positive in terms of space usage. I think frankly, Regent is probably a model. Many real estate companies are a model, right? When you do business outside of just one local area, you have a lot of people who are on the road all the time, right? Well, those people, when you're a sophisticated, highly trained, intelligent real estate professional, you don't want to get back to your office and share a desk, right? The last thing you want is a hot swap desk right now. That just sounds dirty, right? So I think where the industry is going to move is you're going to have your own personal space, right? CBRE's attempt at sharing desks, I think that will probably fail. I think that part of WeWork's business is going to prove to be a dead end. So you're going to see utilization of office space go down, but you're going to see space demand stay roughly same to maybe even slightly positive.
You made a comment, Eric, about do you really want to be competing with Starbucks in the whole shared space? I found that.
Yeah, well, I stole that from Sam Zell. I mean, Sam Zell criticized WeWork's model a year or two ago by saying, you know, if you're in the business of competing with Starbucks, you have a problem, right? Because Starbucks, but you have to boil down, you know, WeWork really has, from our point of view as an office landlord, kind of 3 different components to their business, each of which is being hit differently in today's world, right? The first part of their business is what everyone thinks their business is, excuse me, which is the true shared desk open office, right? I show up and I sit at a long table and, you know, there's a coffee bar or, you know, a keg of beer and I just kind of hang out on my laptop, put on my headphones and do my work. That business is dead, right? WeWork is based on, not just picking on WeWork, a lot of the co-working guys have lost almost all of their subscribers to that model for all the obvious reasons. Those people are sitting in their apartments, they don't need to pay a monthly, they don't want to go show up and get sick. I think the part of WeWork's model that was always kind of interesting was the business model of a shorter term, higher rate private office, right? That's really not that different from what Regis and many of the other co-working operators did for decades, right? I think WeWork probably did it a little better because the third part of their model was highly amenitizing that. And I think Regis and some of the other groups learned from that and provided including us, right, much better tenant amenities. And I think that's the other thing we're going to see on the side of this, right? I think we're all kind of killing to get out and go do stuff, right? Like just to go sit and have a coffee at a coffee shop instead of drive by. So I think the idea of having some common amenities is going to be a huge plus, but everybody wants to be able to go back to their private office and shut the door and feel clean again, which means, and I think that's probably similar to everyone on this call, right? We are upping our janitorial, you know, 3 to 4 times for each building, right? We are cleaning restrooms much more than we used to. I think you're going to see a whole new trend of varying degrees of wellness, right? So we're going to be marketing that, you know, we have scrubbers in all of our air filters, right? That we're disinfecting X, Y, and Z, that, you know, every 10 feet, we're going to have a sanitizing station and wipes and all that kind of stuff to make people feel comfortable.
Thank you, Eric. Stephen, I think we're going to be using retail differently. I think that, you know, we know that the weak aren't going to survive. And I know that you were already starting to take some of your shopping centers with too much retail and start to put apartments in there and do multi-tenant. Can you talk a little bit how you think the evolution is going to be sped up because of COVID, and what do you think is going to happen with the shopping center and the power center? You know, there are going to be winners and losers.
Absolutely, Gary. So I think that to Eric's point, what Eric mentioned, amenitizing offices, I think that you'll see in retail a lot more creating experiential environments. People are looking for an experience, and that experience needs to be clean and needs to be comfortable. I think that people having, I think that the addition of apartments is very interesting in that you have locations that in which it's difficult to entitle new apartments, but where cities are very cooperative about converting retail into apartments. I think that those apartments provide built-in traffic for the retailers, and I think provide, you know, some very interesting opportunities for the omni-channel distribution that is so important to retailers. I mean, let's not forget, you know, 3, 4, 5 months ago, Target had an earnings call, and Target was the darling of Wall Street because Target was really capitalizing on online ordering and in-store pickup, and as opposed to Amazon that had the high costs of delivery, and that isn't going to go away. So I think that you know, we're seeing, as you said, Gary, the strong get stronger. the weak are unfortunately, not are going to go away more quickly. But as the strong get stronger, part of that also is in understanding how to make people feel more comfortable, is also in their distribution to their customer. And, we think that, we're not seeing a shortage of retailers. We have focused on A quality locations where we have more demand for space than we have space. But I think that adding apartments is something that enhances the retail and really also takes your retail from lower rents to higher rents. And ultimately it provides a better, an opportunity for a better experience for the customer. And that's the direction that we see a lot of the great retail locations going in.
Steve, what do you think happens with health clubs and theaters?
So I can speak a little bit more specifically to health clubs than to theaters, but I'll try to speak about both. As it relates to health clubs, I mean, the state of Utah is allowing health clubs to open as early as this Monday. But what health clubs need to do is figure out their model for social distancing, for how is the customer going to feel comfortable that they're not going to pick something up or catch something. And there has to be a distancing model such that they have to limit the number of people who can come into the clubs at a time. And it involves, and I think that the fitness operators are coming up with what their operating model will be and how they're going to communicate with their customers. And will this be sufficiently profitable? Because the value proposition is a very inexpensive monthly membership for 24/7 access. And I may live, person may live in their 2-bedroom, 900 square foot apartment, and coming to the health club is that they have the roost of a 40,000 square foot country club. And all of a sudden, now, at least initially, there will be the social distancing and the spacing. But to the extent that a health club is well capitalized and isn't over leveraged, I think health clubs will come out of this in a way that to capitalize on an overall trend for health and well-being that will emerge. But again, with what that looks like in terms of the distancing that they'll have to observe is to be determined. And I think in the context of movie theaters, you see the same thing. In terms of, you'll see that if a movie theater will be able to open, there will have to be substantial distancing. We're seeing a trend, and we're looking at implementing this actually in some of our locations that are sufficiently large, of actually outdoor movie theaters, and going back to sort of a drive-in where the space is there, and where one can provide an opportunity for one's retailers to, and one's restaurants in particular, to service people watching movies. So I think that movie theaters will need to figure out how they can provide a service that is unique and that is sufficiently attractive and safe. And as every retailer will need to do, and learn from the Krogers of the world and the other groceries of the world, what makes a customer feel sufficiently comfortable coming into the store? What is the value proposition? And at the same time, how do we make the customer feel sufficiently comfortable that it's worth it to come into the store?
Thank you very much. Timur, you're on mute again. Let's just riff off of some things Steven's saying. Is that, we're seeing too much retail, the stores are going to start doing a little more fulfillment at the stores. You're going to be able to do more pickup. You're not going to need as much just in time. How do you think that's going to change the way we use industrial in the future?
Well, I agree with Stephen that, we're very fortunate that we're in the industrial space, and how e-commerce has completely and structurally changed our business. but the omni-channel distribution is a very important part of the overall process. And Target is done fabulously well on this. Nordstrom's doing it. Walmart's doing it. So, you know, I also like to say I'm in the retail business right now because we, you know, have several Amazon locations within our properties. So I think that it's clearly been a great demand driver in our business. We're also seeing food and beverage companies take more space, but we really haven't seen this whole last mile network being built out other than Amazon. FedEx and UPS have definitely grown their footprint over the last 12 to 24 months. But really, to me, the next step is, are we going to see the Home Depots, the Costco's of the world, or the, you know, I don't think the supermarkets are going to be having last mile facilities. They're just operating in such a low margin business when these facilities are so expensive to build. If you're going to build cooler spaces, $150 a foot, why wouldn't they continue to use, you know, Stevens Grocery Center and Instacart to get that that last mile piece to the house versus building infrastructure? So I don't know if I answer your question, Gary, but I think it's a combination of having some last mile facilities, but also using the existing retail footprint that's there, and it works.
Great, thanks very much. Alina, why don't you take a couple questions right now, and I'm going to read the questions that people are sending in. Please send questions to us through the Q&A. We'll try to get to them all. Alina, why don't you ask a few of the questions we had on our agenda?
Sure. Yeah, no, what I was interested in, you know, some lessons learned from the last recession, what worked and what didn't work this time around, and, you know, where you see us heading, and how you're going to address the situation in the short term and in the long term.
I'll hit it real quick. From my perspective, I mean, one of the two biggest lessons learned that I had looking at the Great Recession, looking now transparency, and whether it's transparency with lenders, partners, customers, extremely important. You need to tell the good news. You also need to tell the bad news. And the other thing is that, you know, we're going to, in the industrial space, we're going to catch a cold as well. You know, we're not going to be insulated from this. So the other thing that we're all trying to figure out, where are rents today? And I have found that my first rental rate cut is always my lowest rental rate cut. So I think getting ahead of the market is really important.
I would agree with that on the multifamily side. I mean, we decided very early into this process to pull back on increases, flat renewals, keeping heads on beds, and really making sure that we were reducing friction. So I think you got to be ahead of it, and you got to err on the side of being conservative, not pessimistic, but realistic. And I think, as Timur was saying, you've got to be communicating, whether it's with your residents, your partners, your lenders. You can't be in denial. You got to be way out in front of it, because people reward that, and they reward it with their equal goodwill.
Eric, how about you?
No, I think that's right. I mean, we reached out to every single one of our lenders in March and just said, hey, you know, we want to talk to you, say a hi, check in. I think they all freaked out thinking that we were having issues. We said, no, we're not having issues. We know you guys are dealing with your hotel loans and you're dealing with your retail loans. And if we have problems, it's not going to be April. We'll see what May looks like. But, you know, so far it seems okay. We're making our payments. We just want you guys to know that, so that, you know, we're probably going to have some issues we got to deal with, right? And we already have one tenant who actually wants to negotiate a much longer lease, but wants a little bit of a rent break right now. It's a great thing for the property. It's a great thing for us. It doesn't fit the loan. So you got to go to the lender and have that discussion, right? And you got to explain, listen, the environment we're in, this makes a lot of sense, right? Let's do this. And I think if you have that transparency, you got a big problem longer term.
One of the questions that came in over the chat is, we're going to use our space less densely. So is that going to affect rent? I mean, if if they're using the same amount of people, Eric, in that situation, we said they're going to want 120,000, 120% of the space. Are you going to charge the same rent because they're not used as densely?
Yeah, so I talked about that a little bit, but I think if you dial down, right, you got to remember that all real estate's not created equal, right? So in the retail business, right? I mean, as Stephen can address, right? Tenants will often pay 15 to 20% of their gross margin in terms of rent, right? So if your sales are down, you have a real problem making your rent payment, right? In Bob's business, right, depending on the market, you could be 25 to 35% of your income goes to rent. Very significant. If you have income issues, it's a problem, right? The good and the bad with office is most of our tenants typically pay 2 to 2.5% of their P&L in terms of rent. At the high end, maybe 3%, right? So that's why when a company's going bankrupt, it's their corporate office lease is the last thing they deal with, for good or for bad, right? And that's just the nature of the business. And so I think as we see, and I do think you're going to see space needs stay roughly the same. Maybe there'll be a positive increase, and we're pretty conservative thinking that. I don't think you're going to see rent move very much, right? Because of that. I don't think you're going to see landlords lowering rent because, people need more space. I don't think you're going to see landlords taking advantage of raising rent because of the environment we're in, right? You're just talking about expanding existing usage, and that's going to be a multi-year process, right? As office leases at the short end of 3 year and high end can be much longer, right? So I don't think you're going to see rent movement because of that. The question is, you're going to see rent movement because of lack of demand because of this the shock that we've seen because of coronavirus.
Great.
Thank you, Eric. We have another question for Steve. With tenants who are requesting rent relief, have you worked lease extensions or other forms of compensation into negotiations as a condition of short-term relief? And on our one-on-one, you had a really strong opinion on this. And it was sort of a trickle effect, tenants coming to you, initially asking and then sort of retracting. And I found it interesting that you brought sort of the time value of money discussion into the discussion. Do you want to address that, Steve?
Sure. Well, similar to Eric's experience, our initial reaction when tenants asked for rent relief was to send them an application to tell them you're obligated to pay rent, but if you have hardship because of COVID, send us your financials, send us proof of your need. And the difference is that in our case, they didn't send the information, but some of them paid rent, many of them did not pay rent. But what is clear is that I'm finding that there are a very small percentage of tenants that are having that we're seeing at this point that are having trouble, that they really can't afford to pay, that they don't have the money with which to pay the rent. But at the same time, we're finding that tenants have significant challenges in their inability to operate, such that they need help from landlords. So, what we've done is on a case-by-case basis, we've really listened hard to what's really important to the tenants. And then we've looked at what can we do. And in most, the vast majority, well, not the vast majority, I would say in all of the cases, what we've done is worked something out where there's a current payment now and there's a deferral. Depending on, there's a deferral for 6 months, for 12 months, and in some cases for 18 months. And where there's that deferral, the question is, why are we giving the tenant the deferral? If they're obligated to pay the rent, why are we giving it to them? And I think that, what we look at is, the importance of the relationship, what consents we need right now, what consents we may need in the future. Retail is always changing. Retail today, 20 years ago, everybody thought Walmart was going to destroy retail. Now we're in an environment, a couple of years ago, the thought is, and today is, that the internet is going to destroy physical retail. But physical retail remains, and it continues to evolve. But what that means is that the leases of 10 and 20 years ago will often need to be modified. And for that reason, it's important to have good relationships with tenants. So what I was mentioning when we spoke separately about the time value of money is that the true cost to the landlord of deferring some of the rent is the time value of that money. And where a tenant wants a longer period of time, I think it's appropriate for a tenant to pay a cost of capital on that money. And where it's a relatively shorter period of time, obviously depending on the amount that we're dealing with, it's not that expensive. It's not that great of a cost to a landlord if this really helps out the tenant. And we, as Timur was saying earlier, we always want to make our leases better, whether it's eliminating a termination right, whether it's, in retail, looking at how we can create more value. There's, once upon a time, retailers had to have 5 cars per 1,000 of parking. Today, even at Walmart is recognizing that better to have 4.5 cars of parking and have more retail activity that will bring customers to their shop, to their location, who wouldn't otherwise come to their location. So we're working with tenants on bringing in restaurants, bringing in drive-throughs, and bringing in Walmart wants a certain customer demographic, and if we as a landlord can deliver that demographic, then the doors are open to have discussions we can never ever have before. There's the trade-offs. The trade-offs are there, but we believe that we're doing it in a way that the tenants benefit, but ultimately our investors benefit from the deals that we've made with tenants.
I want to shift gears. We're all 4 of our panelists are very well capitalized. So how are we going to take advantage of it? What are the key signs we're going to be looking for? How are we going to be buying? What's our underwriting going to look like? I mean, where are we seeing rent growth, which our existing portfolio, where do you think would be rent growth versus, it's more with an apartment where it's marked to market every day versus a long-term lease, maybe an office. But how are we changing our underwriting? How are we looking forward? Where are we looking for the opportunities? Is industrial still going to be the darling? Timur, can you start off with this? You're on mute, and tell us a little bit what you're saying about.
Well, I think the key sign for me is lease transactions. We haven't seen any lease transactions post-COVID, and we need to see those lease transactions. Otherwise, it's impossible to underwrite any real estate right now. And from a rent growth standpoint, personally, I don't even, Gary, you always say we're the darling of real estate, but warehouse space moves with GDP. Warehouse space moves with imports. Warehouse space moves with sublease space. And so I think from a rental rate growth standpoint, I think we're fooling ourselves to have rental rate growth. I know every project that we've looked at the last 3 or 4 years, we've had rental rate growth. I think for the next year or two, I don't think we're going to see it. So I need to see leases. I need to see transactions, and then we can start talking about underwriting.
Great. Eric or Bob, Bob, why don't you talk about what you think seeing, because you mark to market, monthly on a lot of your projects, and you have a much current handle. It's not like a hotel every night, but your mark to market is pretty instantaneous.
Yeah. So right now there's a lot of ambiguity because it's very hard to look someone straight in the face and say you're going to have rent growth, but you are going to have rental demand. That's going to continue to occur because I think you're going to see smaller households coming out of this, and people are going to want to have their own spaces. So, I mean, I think if anyone is underwriting deals right now, they're obviously looking at flat to negative growth in the first year, possibly 18 months. And then I think we'll start to see growth in most major metros coming out of that in the second year. The problem right now is there's a huge disparity between what a buyer wants to pay and what a seller wants to sell for. And buyers want at least a 10% discount to take a COVID type risk right now, is what I'm hearing. And unless the seller's desperate, they're just not going to do it. So I think until someone blinks, you're not going to see enough deal flow to say, okay, that's a reasonable discount to take that, call it risk, and that flatter growth the first year or two. So returns that were value add returns in the mid-teens 3 months ago now have to be in the high teens to low 20s on a 5-year hold at, say, 65% leverage to get people to move their equity. So it's going to take a little time.
And as Lena and I know, the debt markets, probably 65% of the lenders have gone out of the market, and the lenders that are remaining have tightened their underwriting and widened their spreads. So I think that real estate's a capital intensive business. There's plenty of capital out there, it's just being very selective. You can make your money on the buy, you will take this more expensive capital, but if not, you're not gonna go forward with it. Eric, want to talk a little bit about, because I know that you love buying in these distressed markets.
We do a lot of distressed buying. But I think Gary, your point is right on, right? As we've been, shifting from just defense in kind of the last 2 weeks of March to probably 50%, probably 75% offense across our team, because we have a great asset management team that's been managing to, put out the fires we've had. Even if Timur gets his lease transactions, right? So he feels comfortable with the rent, right? And even if Bob finds his seller who's willing to meet his 10% discount, right? The issue that we're seeing is that you said 65% of lenders are out. I mean, our impression is that everybody's out right now, because the guys who aren't out aren't really doing anything except they're slapping a 200 basis point higher rate on a loan, feeling, okay, nobody's going to get mad at me in the credit committee, if I throw out a term sheet like this, right? So we were negotiating on a portfolio that had to sell. I would say a pretty distressed portfolio, mildly distressed, depends on your version of distress. And our comment was, listen, if we can figure out how to get your existing lenders to stay in place, we can pay X, but I don't think we can. So we're going to have to go all cash. And, here's the bid. And I think they threw up, right? I said, well, you tell me how else you'd like me to do this, right? So there's a whole nother discount, right? Because we're back to that part of the Great Recession where you couldn't get a loan. And if you couldn't get a loan, you were buying all cash. Now, how long this lasts, I don't know. But I think that's why until you see the credit markets at least feel comfortable making a loan at whatever LTV, right? And stand by that, I don't think you're going to see many capital markets transactions unless you have somebody who needs to sell. And we have a couple of folks we're dealing with who are like that, who are willing to capitulate at an all cash price.
We're finding lenders, because nobody knows what value is, because there is enough transactional volume, as you said, that we're going to just take pre-COVID values down 10%. And, Bob's analog, that you need 10%. So if I was a 75% lender, I'm a 65% lender. If I'm a 65% lender, I'm a 55% loan to value lender. They're also looking at debt yield, where something was 8, now it's a 9.5, but that 9.5 is on much more strict, looking at that sustainability of cash flow in the long run.
So this is Stephen. The irony is that we just signed a 7-Eleven lease, and we got a term sheet from a pretty major commercial bank to lend at 85% loan to cost. And so we're seeing lease transactions get done in retail. I think
also a single A rated customer.
That's right. And I think that the financing that will be available will be very relationship based, as opposed to the institutional capital is just very expensive, as Eric is saying. And I think that in retail, the opportunity is that everybody is so negative about all of the retail, but that at the same time, there's the opportunity not only to enhance the retail, but to introduce multifamily as a part of it, and to otherwise look at the same asset in a completely different way than the current ownership is looking at it.
Well, I think part of the thing we're talking about offense and defense, a lot of the lenders have taken all of their loan officers and put them into asset management to deal with all of
No question about it.
So there's just not enough bodies there. But I think people, have to make money, and they make money in lending by putting money out. And I think that there's, a lot of capital in the system. And I think with the government pumping it up, there'll be more money.
Gentlemen, sorry, Gary. I just wanted to let you know that we have about 5 minutes remaining. So if we want to close out.
Go around each one, give us a closing comment or statement. Timur, do you want to start off with giving us a few nuggets for take-home value?
Well,
go ahead.
Yeah, I guess, stay healthy. Let's hope that we can start slowly opening up our economy. We need it. We need jobs out there. We need It'll help to make our tenants pay rent. But I would think really that, and I've heard it, I think from Eric, and others here, it's really going on the offense. You know what, we're a very entrepreneurial country. Our industry is extremely entrepreneurial. So to me, the take-home nugget is be positive, get out there, and be a glass half full type person right now.
Thank you very much. Stephen?
I would say, be proactive and not reactive in getting ahead of everything, and, make the best out of the situation. There's nothing we can do to change it, and we need to look at what the cards that are dealt to us and make the most of them.
Eric?
I would echo what Timur and Steven said. I would say that what's keeping me up at night thinking is not our portfolio, which is in great shape, and we have a great team managing it, and not the offense, which I think we always do find good deals and make money for our investors. But the question is how the social contract in the United States is going to change with respect to real estate, specifically from a jurisdictional point of view. We have a commercial moratorium in California for the first time ever. No one's ever going to give a handout to real estate, the real estate industry, right? Nobody cares about the evil landlord. So the question is, do you see a continued evolution of, blue states being less and less friendly to property rights, to real estate lenders, and how does that trickle through to multifamily, to office, to industrial, versus red states, which, are kind of traditionally capitalistic. And so I wonder over time whether you're going to see that trend continue. I mean, that started before coronavirus with rent control statewide in California and the city of LA being even more aggressive, et cetera. So that's what I would say is a question for the audience to think about is where do we go with this and how does this trend continue? Because I don't think it's going to stop.
One of the topics that we didn't cover, sorry, Gary, was pandemic insurance, rent interruption insurance. So maybe for another webinar.
Well, I think that we all have to call our councilmen, our congressmen, and our senators and talk about that we really work in an ecosystem, and that the rents pay the property taxes, they pay the employees. Most of the investors are small, widowers and pensioners and all the people that they always worry about, and that you have to really think about, the whole ecosystem. Bob?
Gary, that's what I was going to say, and consistent with Eric was saying. First of all, you have to be cautiously optimistic here. But on the other hand, with regard to some of the negative press or the forgotten man as the landlord here, and how we're being affected, is I think we need to do a better job as an industry of communicating that the economic ecosystem provided by real estate owners is huge, and that only, I don't know, whatever the number is, 7 to 10 cents on a dollar really trickles down to the ultimate corporate owner of the real estate or the individual owner. 90 cents is going to pay payroll, materials, goods, and services. And that is part of our economy. And it's not some evil landlord standing in a tower just counting his money. So I think we need to do a better job of communicating.
Great. Just to wrap up on the capital markets. The capital markets are having problems right now, but there is still capital. We think that it's becoming more inefficient for efficient. So instead of calling 3 construction lenders, I'm going to have to call 25 construction lenders. Instead of calling 2 bridge lenders, I'm going to have to call 30 bridge lenders. Our job has gotten more difficult, but there's still capital out there.
Well, Gary, are you saying you used to only call 2?
No, we should only call Gary. It's just Gary. That's it.
Thanks,
Only
Eric.
Gary.
One call to Gary.
Thank you, everybody, for your time. We really appreciate it. This program has been recorded. You'll be able to find it on the George Smith Partners website and on our YouTube channel. And until next Friday, we have, I think, 2 weeks from now for our next Finance Friday. Thank you very much.
Thank you, everyone.
Thank you. Bye.